Hi there, good evening. You've joined us right here on this special show that we're calling Chinese Jitters. I'm Taneia Bharadwaj. With me, of course, is Nikunj Dalmia. And well, I think it's more than just jitters, Nikunj, bumps, if you can call it, tremors, and clearly there's nowhere to hide.
Well, it's not the end of the road, but yeah, it's a bump on the road for sure. Nobody was expecting such a poor start to 2016. We've seen such ugly volatility in the past. It's not that China has never corrected 5-7%. We've seen many 5-7% corrections in 2015.
Sure.
But A, confusion, chaos about the new circuit filter. B, markets were not prepared for such kind of a new start. And then adding to that good old concern, China's devaluing yuan.
Well, in case you've just joined us, let's quickly recap the top story for the evening and actually for the day. And that, as Nikunj said, is clearly the bloodbath in global markets. On the Wall Street, you had a wave of panic that's clearly swept over Indian equities, erasing all the strides that we've made in the last 1 year. And so you've got the Sensex that actually hit a 52-week low, managing to recover just a little bit, but nonetheless ending at something like a 19-month low. You've got clear indications that the pain is far from over, and here's why we're saying it. Remember, it's all started with another crash in China. You've got a surprise devaluation in the yuan by the Chinese central bank, and the rout was so bad, Nikunj, the trading actually halted in Shanghai for a second time this week.
Yeah, and the trading today lasted for only 7 minutes. So traders actually went home early. So officially it was a holiday for Chinese stock markets.
Yeah, it's like either you short or, just go home.
Exactly,
yeah.
Exactly. So trading was halted for the second time this week, and the domino actually hit the energy market too. Oil prices plunged further to a 2-week low as traders feared that a contagion or a demand erosion from China could have an impact on the largest commodity of the world.
Well, that's right. In fact, we've got a stellar lineup for you to talk to you about the way forward and what you as an investor really should be doing in a market like this. But let's stage the set for this discussion. Poonam Sani and Darshan Mehta from our research desk join in for just that. And Darshan, you go first. It's been quite the carnage on the Wall Street. Actually, it's been a pretty forgettable week if you come to think of it. Recap for us what 2016 so far, mind you, it's just the 7th today, has been like.
A lot of brokerages have come out with notes in terms of what they expect as far as China is concerned and what they expect as far as India is concerned. First of all, CLSA believes that, the yuan devaluation that has happened by China and what they've done is one of the main reasons for a weak market that has come in. But they're saying that this depreciation which has happened over 5%, that should slow down very, very soon, given the fact that, there will be small appreciation as far as the yuan is concerned and slower dollar gains that will come in. Nomura also has a note on China in which they are saying that the physical property market is resilient as of now. They are saying that, the unfolding credit cycle could pose a big challenge as far as the economy is concerned. A lot of these sectors have high leverage. So, materials, capital goods, utility, real estate, these are the sectors which are having a lot of leverage as far as China is concerned. And the bond market is something that they believe now will help generate new credit. Lawrence Balanco of CLSA believes the fact that, the head and shoulder pattern that has been currently formed gives an indication that the Nifty could have a downward targets of anywhere between 6,900 to 7,000, and the correction that we've seen of March peak is something that they believe is a partial retracement from the advance that we saw in August 2013. So clearly not very, very positive views coming in on India and China from the brokerage community.
Now it's also, Dash, thanks a lot for that. Poonam, it's also important for us to put the pieces together. China is the problem, but that problem is having impact on crude, global volatility and emerging market currencies.
Well, it all in fact started with China fixing the yuan much lower. In fact, the yuan midpoint was fixed at 6.56 to the US dollar, 0.5% weaker than the previous fix, and that led to yuan in fact falling to a near 5-year low. Also, the China market stumbled by nearly 7% and were halted. It was a second straight halt in just 4 trading sessions. The China forex reserves also fell close to around $500 billion in 2015, the biggest annual drop seen on record. Not not just that, even World Bank has gone ahead and cut the global growth forecast to 2.9% versus a 3.3%, citing China concerns and also oil slump. But they also state that India is likely to be the fastest growing economy in 2016. Look at what has happened to crude. In fact, the oil has extended losses on high stockpiles. The Brent as well as the NYMEX fell to a 12-year low. Canada crude oil prices also fell to record lows, and OPEC crude oil slumped to below the $30 per barrel mark. This was the lowest since April of 2004. Asian currencies were all in a sea of red except yen. A regional currency war is what is concerning the investors. The won has hit a near 4-month low, ringgit near 3-month trough, Singapore dollar at a 6-year low, Australian dollar dropped to a 2-month low. It was only the yen which rose close to 4.5 at a 4-month high against the US dollar on the perception of safe haven. It seems that volatility right now is likely to continue on China concerns and oil slump.
Okay, now let's discuss the market outlook going forward, and to do that we brought both local and global views. Vikas Khemani from Edelweiss, Medha Samant from Fidelity Worldwide, you've got Michael Husson from CMC, and we've got a voice joining in from London as well. Vikas, let me start the discussion with you. Good evening to you and thank you for joining us. 4% in 4 days. It is scary, selling is intense, and no one has a clue.
No, absolutely. I think, Nikunj, currently we are in a kind of global situation which is very complex. Obviously, US is strong, China is very weak, and commodity prices continue to remain, in trouble, and that puts pressure on the banking system in turn, because there's a lot of exposure towards emerging markets and the corporates. There was a figure that almost $23 trillion is outstanding from the banking system towards emerging corporate markets. So if commodities continue to behave the way it is, and it can definitely scale into a full-blown crisis. So I mean, that possibility is kind of there. So right now we are in a situation where one doesn't know what kind of triggers would come. Situation is very complex, and I think China has kind of triggered it off. So one has to really see how it can settle down. Chinese currency devaluation is one big risk which most investors are watching out. So clearly you have to kind of take this year the call, has emerging markets bottomed out, or there's a lot more pain. And I do believe that from emerging markets perspective still more pain is there. Until then I think India will continue to suffer from overall emerging market phenomena, both overall from liquidity as well as the sentiment. And I think currently we are where we are, because if emerging markets funds see outflow, India cannot remain out of it, and on the top of it India would probably see more accentuated flow, because you sell what you can sell. So some markets you can't sell, and hence I think India probably will see more impact. So I think that is the kind of situation we are in currently.
Vikas, at the start of this year, I remember reading an article by you which said that India, you believe, is in the middle of a structural bull run, and despite the global headwinds, you believe this is a good time, especially at lower levels, for investors to look at, accumulating stocks. Do you stand by that view?
No, absolutely. I said that in my article that this is a year of improvement domestically. Every count we are improving. Global environment remains very, very complex, both from a economic standpoint of view as well as the geopolitical standpoint, when both risks are very, very high, and in what form they will manifest one doesn't know. But if you look at India, this next 3 to 6 months, whatever correction can happen in the market, it could be 5%, 10%, one doesn't know, because this is the kind of, it all clearly depends on what kind of global situation pans out. And any such opportunity because India in 3 to 4 years or 2 years, long term if you take, it will give a great opportunity, because most of things are moving in the right direction. So no doubt on that. Now, so it depends on whether you are fully invested or you are not invested, but I do believe that we are in the middle of a structural bull run, and I think India cannot remain, India cannot escape anything which is happening globally, and I think in any such impact will give opportunities to the investors. And Indian investors are very, very under invested into equity as an asset class. If you see our exposure towards equity as an asset class is very, very, less than 2-3%. So I think this is again in turn, I do believe, a great opportunity for Indian population to kind of increase the exposure towards equities.
Okay, Vikas, stay with us. Ipek, this question is coming your way. What is your understanding of market volatility? Because the key highlight or the key differentiator for this year so far has been a sudden and a big jump in global volatility.
Well, actually, the volatility is a result of no one knowing what's going on right now. So there is a big panic after the Chinese stocks have been closed 2 times this week only. So the volatility is not ready to ease anytime soon, because we see like bloody red picture on the market right now. Investors do not really know where they are going. So it's not equities for sure. In the morning time in Europe, here in London, we have seen some demand for Eurozone sovereign bonds, for example. That's over again. So now the Eurozone bonds are trading with losses also. So it seems like people are just like moving to cash. And as the amount of cash is growing, the opportunity for investment the palette is very large. And if people cannot decide on where to invest in this very volatile situation, that can only help the volatility getting higher. So this is why I think that the speculation is going to be the main case scenario until we can find some real fundamental reason to get back into the market and get invested in any market, in any sector, or in any bonds, stocks, cash, equities, whatever we can think about. So I believe that the volatility is coming from the fact that nobody really knows what's happening right now.
Right. Medha, if that's the case, and if there's so much ambiguity about, what's really going down in China, then do you believe somewhere that this sell-off is perhaps overdone and even unnecessary, or would that be, looking at it from a very oversimplistic point of view?
Well, there are a number of things going on here. One is definitely the stress on the global economy, what's happening with respect to global growth, especially in the developed markets. Secondly, China continues to remain an important part of the global economy. It's a sizable chunk now. So any sort of slowdown in China in the economy will have a contagion impact. Sentiment has also been impacted because of the commodity cycle and, what's happening to commodity prices, oil prices, etc. So it's really a combination of these factors which is putting markets back into risk-off mode. Investors are looking towards, safety. We are definitely seeing that trend coming into the market. So that's likely to continue for the short term. But yes, rightly so, it's still the domestic A shares which will continue to be under stress.
Well, whether it's the cause or the effect, crude prices have plunged further. And Michael, that is the big problem area. Falling crude is, initially was considered to be great news for countries like India, but currently crude has really moved away from that sweet spot. So oil prices have corrected to a 12-year low. What is leading to this sell-off, and are you betting on any kind of a recovery this year?
Betting on a recovery, I think that's the million-dollar question. I think there's a potential for further declines towards $25 a barrel. I think this spat between Iran and Saudi Arabia counterintuitively could actually weaken the oil price further, because neither party is going to be in any mood to cut production to push prices higher. Essentially, we're at an output war here and a battle for market share. So the differences between Saudi Arabia and Iran, I think, are going to make it much less likely there will be an agreement on output cuts. That's likely to weigh on prices for probably quite some time to come. If we do see a rally, then I think we'll see a rally to around about $45, maybe $50 a barrel at a pinch. And obviously that's barring any geopolitical flare-ups in the Middle East as a result of obviously the lower oil prices that we're currently seeing.
Because this question's for you, and last year it was all about how FIIs somewhere turned their back on Indian markets. Of course, thankfully we had the DIIs that really managed to hold things up for us. Is that a trend you see continuing into this year as well? Because in the last 4 or 5 trading sessions, we've seen the FIIs sell something like 1,800 crore rupees worth of stocks in the cash market, that is. Should there be this wave of risk aversion, in the world, do you believe that somewhere under threat will also be the DII inflows then into our market?
Absolutely. I think, whole of last year, I think the expectation was that markets will start performing, and I think domestically most of the investors were optimistic and they were hoping to make money. And I think fact of the matter is that last 5-6 months have been fairly disappointing and money has not been made by the investors. So I think that will have definitely some rub-off effect. Typically, investors put more money when the markets do well, and when markets are sort of not doing well, the contra money obviously goes down. So that risk is very much there, and as the environment vitiates, I think probably domestic flows might also slow down, and that's the actually single biggest risk which is there to the markets right now. That last year DI absorbed most of the selling by global emerging market funds, and if that slowdown were to happen this year, I think the fall could be very accentuated. But I'm sure there's an equilibrium in the market will find, and if there's a sharp cut, the contra buy or long-term buyers will come and start buying. So, but that risk is, to answer your question specifically, that risk definitely remains there. Already we are seeing some sort of fatigue in this in the domestic flows.
Let's talk about banks. And banks have frankly nothing to do with China. Banks don't export to China. Banks have no connection with Chinese companies. Why are Indian banks suffering? If everybody is confident that Indian economy is bouncing back and government is doing all the right things, banks should not suffer the way they are suffering.
So Nikunj, what happens is, it is not about only, I think definitely banking sector right now is going through a peculiar situation where, there is a expectation that in this quarterly earning there could be a lot more with the recent RBI initiative of, having the common NP accounts across the banks. So there is expectation that there might be significant provision coming through in this quarterly earnings. That is the one fear or anxiety markets right now has, and that is the one sector specific, reason why banks have in last couple of days suffering. And also in part generally, you sell whatever, banks are large part of the weight. So whenever there is an outflow, obviously you sell what you can sell, and hence they cannot remain unaffected by the, so one, you have an anxiety, and secondly you have a sell flow. So both kind of compounds.
Okay. Ipek, let's take the discussion back to, the factors at play as far as oil prices are concerned. And, as days go by, levels that we're looking at are, only sort of grinding lower. Just when you think that there's a bottom being made in place, we have prices sitting at a fresh 12-year low. What's the problem, you think? Is it, is it the fact that you've got these supply side problems that exist? Or is it now also add to the fact that you've got demand issues, given that everybody is raising questions on, what kind of growth we're going to see in China this year?
Well, both actually. We see the Chinese economy slowing down, so the demand side is being seriously impacted by China slowing down and all the spillover impacts on the emerging Asia and other economies. But also we see this geopolitical tensions between Iran and Saudi, and nobody really wants to step out of the market and say, okay, I got enough. This is just too low, so we cannot just be viable at these levels. So nobody really wants to say that, and the big players are now really pushing it very, very far, and we don't know how lower we can go. So we have seen the 12-year lows. Now people are expecting the $30 levels are seen around the corner, and Goldman Sachs is still standing behind its forecast of $20 in a couple of months, or maybe within 2016. So the situation just suggests that there might be some more downside in the oil market. However, there is just one risk on the upside, is the fact that we do not know how damaging this is for these countries, so Iran's or Saudi Arabia's budget. So if the budget gets really impacted by this, and then we don't see any financing coming through, that might push Saudi Arabia to just to take a step back and say, okay, now at $30 levels we will be maybe do something, cut the production and keep the prices at the levels where they are, or push the prices a bit higher in order to have a sustainable business model and sustainable prices in order to continue functioning simply.
Michael, ultimately it's all about the Chinese currency, yuan depreciation. Yuan this year has depreciated by about 1.5%. Now that's not large, but that's scary enough. That's big enough to scare the world. So, to your mind, what are the consequences of this sudden devaluation in yuan on other Asian currencies and other emerging market currencies?
I think there's certainly further to go. I think in the short term we may see a little bit of a strengthening of the yuan. We've seen since the beginning of November in excess of a 5% devaluation, and I think Chinese authorities may want to start to temper that a little bit. So we may see a little bit of a pullback to around about 6.6. But overall, I think the direction of travel is clearly established. We could see a move towards 6.8, 6.9. That is likely to have a knock-on effect on other emerging market currencies. But ultimately, I think it's something that does need to happen over the course of the next few months. The yuan was pegged very strongly to the dollar over the past 4 or 5 years, and the Chinese currency has suffered as a result of that, and de-pegging that is going to take some time. How Chinese authorities manage that could determine whether or not we see a short-term base in equity markets globally, or whether we see further declines.
Vikas, let's look away from all these global factors at play and talk about, local ones that will perhaps move our markets. You've got corporate earnings that are around the corner. There's, of course, the budget session as well. What will you be looking out for? Surprisingly, off late, we've had a lot of guests on the show talk to us about how they actually expect the markets to even make a new high as early as the budget session. Would you even consider that viewpoint, or is it just, looking at the world in rose-tinted glasses?
I think my view is quite different. I think first one, maybe for Q1 or Q2 of this calendar, we will be fairly sort of affected by the global environment, and that is kind of keep on coming in some way or other. Obviously, budget is a trigger. What kind of budget gets presented, there will be hope, expectations which will get built. Corporate earnings side, while I think there are certain marginal expectations which are getting built, but there are no great expectations around the corporate earnings. I think it will be a quarter which is going to be all right. There aren't going to be many surprises on the positive side. So I think yes, budget is definitely which holds many expectations, because this is going to be a very important budget, as the government is also kind of giving indications. So there might be a little bit expectation getting built around that, but I think that there's quite some time for that. I think no matter what good happens in India, undoubtedly global liquidity will have a very big impact. So if we see the kind of scenario which continues right now in global markets, India will continue to see an impact of that unless there is a matching flow which comes from domestics. We have a trouble. So I think it is going to be determined by liquidity for sure. I don't think fundamentals will be at play at this point in time. Even if I think something comes great in the budget markets, liquidity will determine everything. But I'm sure this kind of situation is not going to persist. It is going to be today we look very, very pessimist on most count, but I think it will settle down. Panic should settle down, but global situation does not look very rosy. I think yuan will depreciate this time. Fed rate cut is around. So I think next 2 quarters there are a lot of uncertainties, and geopolitical, which I think very few people are talking about, I think can also end up becoming a reasonably good risk. So I think we are not in a very good environment. As I said earlier in my article as well, that there are a lot of global headwinds this year. So maybe I would have hope from the global side maybe later part of this year, but I think early part of this year we will have to live with that, and in that kind of environment, and India cannot remain unimpacted with that, and we'll have to live with that.
Okay, so Vikas, let's get closing comments from you. In this market, are you buying, are you selling, or are you staying the course?
It depends on what's the what kind of investment strategy. I have definitely I'm not going to be in a hurry to buy, because as I said that I see a fairly high risk in this environment. Going forward, still it can scale up further. We have not seen anything significant. I assign reasonably good probability to some kind of a financial crisis in the European banks or some banking system due to emerging market debt exposure. I don't know whether that will happen or not, so I won't be in a hurry to buy at this point in time. I will pace out, or as I said, I think next 1 or 2 quarters I see reasonably good amount of pain in the system, unless it kind of has its way of reflecting in overall markets. I wouldn't be in a hurry to buy in the markets. I would pace it out over next 3 to 6 months, and then I hope that second half would be much better. Definitely long term I am buyer, but I'm in short term I am not immediately rushing to buy.
All right, Vikas, we leave it at that. In fact, all of you, thanks so much for taking time out for us. Vikas, Michael, Medha and Ipek, thanks so much for joining in on this special show that we're of course calling Chinese Jitters.
Thank you for tuning in, and thank you for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.